Hey, what's up, duly diligent investors? Welcome to my first video and channel where I only talk about dividends and memes. Today I'm going to tell you about a very special ETF that's been making waves in the market recently. Please note that this video is not financial advice. It's called TSLY, ticker symbol TSLY, and the main reason why it's so popular is that sweet dividend yield. At the time of this video, it's currently yielding a whopping 116%. If it sounds too good to be true, it usually is. To put that into context, your HYSA, a risk-free place to park your cash, assuming they're FDIC insured, brings an annual yield of around 4.5%. Thanks, Jay Powell. Bonds, another one of the safest and most boring investment vehicles, return an annual yield of around 5%. The market, aka the SPY, returns an average annual yield of around 10%. Real estate averages an annual yield of around 11%. This 2-year-old fund is returning 116%. Do you see why it's so impressive yet? To get these kinds of returns in the long run is basically non-existent in the investing world without taking some serious risk. So how does TSLY achieve these returns? To explain that, we need to dive into the world of options. TSLY is managed by YieldMax. They're known for their super high yielding dividend funds. They also manage AMZY, CONY, and NVDY. All of them operate under the same strategy to generate these dividends. So how does TSLY make these kinds of returns? It's an ETF that tracks the performance of Tesla, TSLA, you know, the electric car company that everyone loves or hates or loves to hate, the one that makes those futuristic vehicles that can drive themselves, go really fast, and catch fire sometimes. Yeah, that one. TSLY is not just a regular ETF that holds Tesla shares though. In fact, it doesn't hold any Tesla shares at all. It solely sells call options on Tesla shares to generate income. This fund is not made for growth. It's purely for income. It's an income play only. Their strategy, in a nutshell, is writing call options on the underlying Tesla. In its simplest form, they write the calls, collect the premium, and then distribute it to shareholders. If you don't understand options, it's okay. They're very complex instruments. That's why you're investing in TSLY, to let them do it for you. Writing call options is profitable if the underlying stays below the strike price. So hypothetically, let's say you're the fund manager of TSLY. At the time of this writing, Tesla is right around $221.51. Thanks, Cybercab. Let's say you think the price won't hit $300 by November, so you write a Tesla 300 strike call option for the first week of November. By doing this, you get paid upfront for taking on the risk that Tesla might go to the moon and explode right past 300, your strike price. Why? Because if it does rocket to 350, it'll be capped at 300. You'll miss out on the $50 gain, which is actually $5,000 in the option world since everything is times 100. And this is per contract that you write. If Tesla stays below 300, then you keep the full premium. Rinse and repeat. This is exactly what TSLY is doing hand over fist. You can see exactly how much they're collecting in premiums, how many contracts they have, their strikes. It's no secret. It's public info. The strategy is valid and there's nothing wrong with it intrinsically. It's kind of like renting out your car to someone hoping they don't crash it or return it too late. When you invest into TSLY, you're paying an expense ratio for them to do it for you. The ratio is right around 1%, which is basically the fee that they collect from you, and it's basically passive since they do all the option management for you. Note that 1% is relatively high. The average expense ratio is right around 0.5%, but it makes sense since it's actively managed and requires work. This is their incentive to make these kinds of funds in the first place. The reason why the distribution is so impressive is because Tesla is so volatile, meaning it's hard to predict where it's going to go next. It can tank $50 or 8 times itself in a flash. All it takes is Tesla missing a delivery schedule or Elon Musk selling all his Dogecoin and literally taking a rocket to the moon to move this thing. That's why the premium for it is so darn juicy. So what about the drawbacks of TSLY? It sounds reasonable. It gives you a huge dividend. It can capture some of the upside of Tesla, and it pays every month. How could you possibly lose? What are the risks? With great yield comes great responsibility. If there's a fund making these kinds of returns, there must be some massive risk they're taking in order to achieve. If it were that easy, all the big boys would be jumping in on the bandwagon. Who would invest anywhere else if you can get a whopping 112% yielding vehicle? Who needs the average market? Who cares about SPY? Who wants a boring 11% real estate yielder? Who would even consider a 4.5% HYSA? Let's all jump into this guaranteed home run fund, right? Here are a few of the biggest risks I can see with TSLY. Number 1, missed gains. As we discussed before, one of the biggest issues with writing calls is missing the gains. There are a lot of covered call ETFs and they all operate similarly. TSLY doesn't actually hold Tesla shares. It only writes calls on the shares. So let's say again you have the $300 call, taking our example from earlier, and then Elon announces that Uber is buying out their cyber taxi business. Then Tesla shoots up to 400. You miss out on all those sweet gains. Your upside is capped if the underlying makes a big move. With Tesla, that's to be expected. That's why TSLY will never jump in price like Tesla does, so your upside is limited. This is why they don't capture all the upside. Call options only allow them to capture the gains. TSLY actually holds a lot of treasury bonds for a majority of its holdings. This is where they can park pooled investor cash to collect some interest on it while being able to use it to write calls. The rest are in smaller put positions and a small cash position. Since they don't hold the shares directly, they don't really benefit when Tesla makes gains. They only capture a tiny fraction of it, but they love to capture all the downside. You either capture the share appreciation or you capture a high dividend yield. You likely will never find something that has both. That would be a unicorn. If you know it, please tell me because I need it. Seems like all the big fish these days want to dip their fins into cover-called funds because there's a lot of suckers like you and I that blindly YOLO into it because of that sweet, sweet yield. If it wasn't blowing up, they wouldn't be wasting their time or energy on building these funds. Number 2, downside risk. Nothing goes up forever. Eventually there will be a correction, and Tesla is no exception. The issue with Tesla is that since they sell calls, there is no downside protection. If Tesla dives 10% in a day because their Texas factory caught on fire because of a car on autopilot that crashed into an electrical converter which happened to be a Tesla on fire, Tesla will capture the full 10% of said drop. So you get all of the downside risk with limited upside gains. Number 3, NAV erosion. NAV, NAV, stands for net asset value. This is a common issue with cover-called funds once again. You may have already encountered this with other popular funds with high yields like Q yield. Did you ever get that mixed feel where you're capturing those sweet, sweet divvies, but at the same time the price of the asset is just tanking in price? It's a bittersweet feeling because you're collecting the dividends, but the principal is disappearing. It's almost like they're paying you back your investment at the cost of the asset price, so you're just barely breaking even. But since most of these funds are unqualified dividends, tax drag may bring you into the negative territory. This is NAV erosion in a nutshell. When the price of the asset itself erodes over time, you're basically losing your principal. You're collecting a huge dividend, but the initial amount you invested is declining, so you may actually be losing money even with that high yield. Depends on many different factors, such as the share price, splits, reverse splits, special dividends, dividend cuts, or whether or not you have DRIP enabled, or if you're doing this in a Roth or an individual brokerage account. So how does NAV erosion apply to Tesla? Well, look at it. Since its inception on the 22nd of November of 22, so let's say you invested $10,000 on the day it came out, you'd have $14,000 principal that you can liquidate for cash immediately. Now look at Tesla. The underlying it's writing its calls on, within that same time span, Tesla has increased. NAV erosion happens when the fund's distribution include a return of investor capital, which can decrease the fund's NAV and trading price over time. This can be particularly noticeable if the underlying stock's price decreases. Of course, you don't invest in Tesla for share price appreciation. Again, it's purely an income play. It's for income generation only. So during this time, you'd be collecting a nice dividend every single month, assuming you invested them to buy more shares. On the other hand, if you just took dividends and used it for beer money and maybe some pizza with wings and an extra dipping sauce, you'd be down on your initial 10K, but you'd have harvested dividends to spend on whatever you'd like. There's a perspective that NAV erosion might not be as significant as it seems, especially if the fund continues to pay high dividends and remains profitable. You don't need Tesla to remain profitable. You just need it to break even. Assuming you leave it alone and don't reinvest, you can possibly make your principal back just through dividends. Once it hits 10K paid out in dividends, the rest is free, right? So now that we've covered the negatives of Tesla, let's talk about some of the benefits. Yeah. Number 1, the divs. The dividend yield is the sole reason why people are drawn to Tesla. It topples the majority of other covered call ETFs by orders of magnitude. Seeing those 50% plus yields in those monthly payouts makes you feel a giggity inside every time you wake up to a notification for your Tesla payout, doesn't it? It's like free money, right? Number 2, passive income. If you do not care about price appreciation nor losing the principal, then passive income is your jam. Tesla has never missed a dividend since inception, although the dividend payout has been all over the place. If it continues at this pace, you may eventually become profitable because the dividends will outpace principal investment and recoup your initial losses. With such a high yield, it may take a few years to break even, assuming the NAV doesn't erode too much and the yield remains above 50%. When you get your initial investment back, then you're sailing free. This is not a wise choice for a long-term investment that you need to depend on. I mean, it shouldn't be your only source of retirement income, but if it's just YOLO money that you can afford to use, why not be a little degen and ride the wave? Dividend payouts just blow your mind. So how does Tesla compare to boring old buy and hold ETFs? Well, not really well. If you look at some of the most popular dividend ETFs, such as VIM, or everyone's favorite SCHT, you'll see that they have much lower yields, but also much higher share appreciation. VYM has a dividend yield of nearly 3% at the time of this video, but because it holds a more diversified portfolio of high-quality dividend stocks, share price and NAV are more stable and much less volatile than Tesla's, which is basically just a YOLO fund into a YOLO stock. That means VYM is much more likely to maintain or increase its dividend over time and far less likely to suffer from large losses or missed opportunities, and also less likely to turn you to a degen. You're more likely to see a Tesla plant meltdown before you see Tesla outperform VYM. So in conclusion, what's the verdict on Tesla? Well, it depends on your risk appetite, your investor goals, and your sense of humor. If you're a risk taker, Tesla fan, Elon fan, meme lover, you might enjoy Tesla's high-octane strategy and its eye-popping dividend yield. You might also find it amusing to sell options on one of the most controversial and volatile stocks in the market ever. But if you're a risk-averse, dividend seeker, and a value investor, you might prefer the traditional boring ETFs to offer a more reliable and consistent income and less exposure to Tesla's wild swings. You might also find it more wise to buy Tesla directly if you believe in its long-term potential and not limit your upside. But if you crave that sweet yield and don't mind seeing your NAV erode, then it just might be the wild ride for you. Put it on autopilot and see where it takes you. It's going to be to the moon or right into a street sign. This is not financial advice. Personally, I might pick up a few shares after seeing what happened with the cyber taxi announcement, but it looks like there's more pain for Tesla up ahead. Might wait it out a bit until I see it round up to the upside. So currently, I do not hold a position in this fund. Either way, hope you learned something from this video and had some fun along the way. If you did, please give this video a thumbs up, leave a comment, share it with your friends, share it with your fellow degens, and let's all become degens together. If you want to see more stupid videos like this, make sure you subscribe to my channel, hit the bell icon to be notified of future videos. Thanks for watching, and I'll see you in the next one. Degen out.